Welcome back, traders and investors. It's time for more grain talk, and today we're going to be speaking with Karl Setzer. He's a grain market analyst at MaxYield Grain. He has spent his entire life and professional career in farming and remains a kid at heart. It's this passion that guides his pursuit of leading edge information and insights that are featured daily in his commentary. Karl, how you doing this morning?
I'm doing quite well. How are you?
Well, I guess we got a little bit of your background already, but could you just give us a little bit more of your education and how long you've been farming? Was this something passed down from the family? Just give us a little bit of your background.
Yeah, Joel, I was I was raised in Wisconsin on a dairy farm. We were in dairy and cattle. And then when I graduated high school, went into the agricultural field in Wisconsin. I actually wanted to go and I actually started out to be a veterinarian, so I ended up trading grains as right on course for something like that. But I've always been a farm kid. I've always been interested in agriculture, and it's just something I've never really left.
Okay. And how much land do you farm right now?
My parents still have the farm in Wisconsin. I'm in Iowa. We've rented it out, but we have altogether about 1,000 acres.
Wow. Okay. All right. Now I know when it comes to the grain markets that it's very important to pay attention to the fundamentals. So just what's your favorite grain market, and then give us that, and then let's talk about the fundamentals a little bit.
You know, Joe, I look at all the markets because everything affects everything else when it comes in the markets. The corn, the wheat, the soybeans, the meals. So you look at all of them. Being in Iowa, we focus pretty much on just corn and soybeans. And one of the biggest fundamental factors I look at is simple supply and demand. We really got to look at that closely. At the end of the day, that is the one factor that drives the market and always has, always will. We do have other ones. We have weather and we have the global market, but interior markets, supply and demand is the biggest factor that really drives it.
Okay, and you threw in weather there. How close attention do you pay to the weather?
In today's market, we really have to pay close attention to weather because it used to be we had a weather market in the United States that started around end of February, March when we were looking at planting season. And then we'd get to, once the crop was planted, we'd see some of the weather premium leave the market. And then a little bit, in the summer and drought, and we'd seen this in the last couple of years, and then always in the fall if we're going to have some harvest delays. But really, we've evolved from having, a 6 to 7 month time frame that weather was a factor to year-round now, and that's the big thing with South America. We can have a perfect growing season in the United States, and if we have a drought in Brazil or Argentina or over in the Black Sea market or Australia when it comes to wheat, the global market really affects it, the global weather. So we really have a 12-month window that we have to pay attention to weather now.
Okay, you just also you mentioned there are situations that were going on in Brazil. So is monitoring the international supply and demand a big part of your analysis?
It really is, Joel. I've went from when I started out in this industry, in the trading and brokering 20 years ago. We didn't have Brazil. Brazil wasn't a factor. Planting corn in Ukraine was unheard of, and China wasn't the factor it is now. So as we've switched over, not only is the demand that we've seen for our grain in the global market bigger, but the competition we see from South America. Brazil is going to kick out another record soybean crop this year. Getting some indications today that their second corn crop, their safrinha crop, is going to be down around 9 million metric tons from a year ago. So we really have to look at the competition, and it can go both ways. We can have a drought in the United States, and for example, last year, look at our soybean crop. We have ending stocks that are getting razor thin. Some analysts, myself included, think they'll end up below 100 million bushels. And soybean values have just been dropping and dropping and dropping. And that's because of the big crop that we saw out of Brazil and Argentina last year that's still hitting the market. We are not the player in the market that we used to be. We're still a big one, but we're not quite as large as we used to be, say, 20, 25 years ago.
So are we basically net importers of all the grains or net exporters?
We're still an exporter. We're still big exporters, but this year we have imported soybeans, and we do import soybeans every year. Usually our soybeans come out of Canada. This year the imports are a little bit higher. So far we've taken roughly 60 million bushels of soybean imports. We also take some meal that comes into the Southeast feed market. And last year we had to import a little bit of wheat out of Canada to cover up the corn shortage we had in the feedlots. But we will primarily, and I could see us evolving, in another 15, 20 years down the road. I think the United States will always be a corn exporter. We may see a shift over that we export more finished product. We export more beef, more pork, more poultry, ethanol. The products start to leave rather than the raw commodity. And soybeans, I would not be surprised if the United States gets in this situation where we do become an importer, not a net importer, but we have to increase our imports of soybeans just to get our needs covered.
Okay, so you spend much of your day hedging MaxYield's grain position and coaching your grain solutions team in risk management. So how much grain are you trying to hedge?
Our yearly take on grain, we hedge around 120 million bushels of corn. On soybeans, around 35 million bushels. And some of that, we do a lot of sourcing for end users, some ethanol plants, some feed mills. So that's included in there also. We do their hedging for them, and we do take on some of their risk management as well.
A guest that I was speaking with yesterday had mentioned that ethanol production, with these low price of corn here, that ethanol production, a lot of these plants were starting to come online, and that might be a little bit something that might add a little bullishness. Are you seeing that at all?
What we've seen, and I do agree with that statement and that comment, we are starting to see some of the ethanol plants that had been slowed, maybe running at 75, 80% of capacity, are starting to push 100%. The thing that's hurting the ethanol right now is they do have cheap corn. Corn has gotten much more affordable for them, but that's one piece of the pie. We also have, on the other end, DDG values have dropped because of the non-GMO issues we're having with China, and they're not going to take DDGs. We've also seen gasoline values dip a little bit. So while corn has gotten cheaper, we're starting to see on the back end, the finished product, we're starting to see a little bit weaker margins there. And with seeing them, that's putting some pressure on the ethanol industry margins. And we're also having rail transit issues. Some of these plants have tankers sitting in the lots. They're full on ethanol and can't get it out. And when that happens, they have to slow the plant back down or take it offline because they simply can't process the corn.
Okay, let's get back to your hedging tactics. Are you using primarily the futures markets, or do you use the options markets as well?
In our industry, being a commercial elevator, probably 90% of my trades are done futures only, and that's because when we resell our corn and soybeans to an end user, they're doing their risk management with futures, so we have to do exchanges, and it's a futures contract for a futures contract. So for a commercial, the board of trade with the futures is usually the best way to go. I know some that use options, and options are absolutely fine, but they take a little bit more work and a little bit more effort when you do use them.
And also, you're defining, you have a specific time value that you have for this, so it could work, and also you have the time decay. Karl, Herd Capital is popping in here, and he wants to know if you have talked about the price forecast for wheat and barley.
Not on barley. We don't have much to do with barley, and I don't really trade that too much. But on wheat, We do have a big wheat crop in the United States. Wheat, in the global market, we're starting to see a little bit more interest. Wheat's really taken a dive here. We're trading around that 550 in the spot market. Look a year out, we're trading in the low $6 per bushel range. It's still holding a pretty good premium to corn. I think we're going to see some strength in wheat, but I think it's going to take quite a bit to get it back to the values that we've seen over the last year or so.
I'm just going through all these charts, and to be honest with you, Karl, these charts look horrible. They just, I mean, I hope you've been selling a lot of. I hope you maybe been overselling a little bit here, because I mean, since May, I mean, these charts look absolutely horrible. And is that just because of bumper crops that are coming out?
What we've seen, and the charts, what we've seen is when we got to the highs, the funds were loaded up. We've seen the funds exit their positions, getting down to, sitting right now, funds are on 80,000 contracts of corn, 35,000 contracts of soybeans, and that's on the long side. Wheat, we're seeing the funds short roughly 50,000 contracts as of this morning. Once the funds started to liquidate, it really put some pressure on the charts, and we did see them drop. We saw a lot of gaps on the way down. So you throw that in, and with the funds getting out, some of the the world economy, there were some concerns about China. We also had the Ukraine issue come up, and you add those together, and then the forecast for a large crop, and this crop coming on does look good. It looks huge. And when we throw all that together, everything is just kind of the perfect storm, and we just saw the meltdown we had in futures here over the past 4 or 5 months.
So you're looking at the commercials and seeing what they're. Do you look at the commitment of traders from Steve Breezy, or how do you just follow the commercials through the open interest in the contracts?
I follow a little bit of both. I look at when I do analysis, I'll look at who's holding the commodity. And right now, commercials don't have the ownership that they have in the past years. So when we look at that, we've got a spec crowd that is sitting long at 100,000 contracts of corn, give or take a little bit, and you've got commercials who are taking the other side. One of those is going to be wrong, and the one that's caught in the middle is you have the farmer who's holding the physical corn, and roughly the carryout this year is going to be 1.2 billion bushels on corn, give or take a little bit. Next Tuesday's reports will show us. But when we look at that, the majority of that corn is being held by the farmer yet. So, that's something that we really, I look at is who wants the product. And if you don't have commercials and everybody else wanting to own the product, it shows me the demand just isn't there right now.
Okay, and besides the futures and the options, are there any other ways that farmers can hedge their crops?
There's products out there. There's the OTC market. There's, everybody's got something a farmer can use. When I work with my clients, I like them to use options, and I try to push them into the options market. And the reason being, they know their cost up front. If they want to go out and buy a soybean option, 50, 60 cents, whatever the premium is, they know what their cost is. They can lock that in. When a producer, a farmer, goes out and takes a futures contract, he's got a lot of risk when he reowns that on the board of trade. He can have margin calls, everything else to go against him. So I always prefer a client and advise mine just to take an options position, Joel.
Okay, and the liquidity okay in that? The market makers make you a good market in that, or does it sometimes get a little dicey to get those hedges on?
No, with options, there's really not much of a problem at all of getting that taken care of. Now, if you get into the OTC market, the over-the-counter options and some of the exotic contracts that they have, those can be a little bit hard with liquidity. But for the most part, with straight options, you'll be okay with that.
And with prices at these rock bottom levels, are the small farmers just disappearing here with with these low levels, just not being able to maintain their expenses, and the big guys pushing them out, the people with the staying power, or are the farmers hedging and be able to get through this downturn in prices?
Well, we've seen a lot of farmers over the last couple of years. They've been pretty aggressive forward contractors, meaning even though cash value is sitting around that 325, 350 value right now, we got to remember they may have made sales up to 2 years ago at $5 or $6, so they can take and they can blend them in. So their actual revenue per acre is sitting a lot better than what we're seeing for a spot bid. That takes me back to a client really does need to have a risk management program, because that's going to cushion the blow when we do have these depressed values on corn, soybeans, wheat, any other grain that they may or may not have. But they really do need to have a plan in place to take care of that.
Do you follow the stock market at all?
That's a good question. I do a little bit. There is some things in the stock market that we have to watch. Not so much individual stocks, but just what it's doing. And that comes back from the financial traders that have a commodity basket, and they started treating commodities a little bit like they have their financial investments. If the stock market rallies hard, if we see the Dow up, a big move, it can spill over and affect the commodities, because if they have to, have a margin call in the stock market, they're going to have to get rid of their commodities. Or if they're having, doing good in the stock market, they might put some of that money in the commodities. And we also have what's referred to as a flight to quality. Every time you see a little bit of a shakeup in the stock market, we tend to see more buying in the commodities, and it's not just grains. We'll see it in the metals and everything else, because these investors want to own something rather than just paper. And if they buy a contract of corn, that's an actual physical commodity that they can own. So I do watch the stock market from that aspect.
Wow, that was a great answer, Karl. Thank you very much. I've got Karl Setzer on the line. He's a grain market analyst at MaxYield Grain, discussing the fundamentals. And, we didn't really get to the technicals on the grains. Maybe we could do that the next time you're on. But thanks for coming on. Have a good trading day, and we'll speak to you soon.
Well, thank you very much, Joel. Appreciate it.